I'm Jamie Dimon. I'm the CEO of J.P. Morgan Chase, and I'm going to tell you about a $25 billion decision. This decision wasn't just about money. It was about the independence of American banking. The decision I made that day changed our relationship with the government forever. And even today, we're living with the consequences of that decision. It was 2009. The financial crisis had just ended. Other banks were still struggling to stay afloat. And I was sitting across from Treasury Secretary Tim Geithner. There was a check on the table for $25 billion. TARP funds, the government bailout money they had given us. Geithner said to me, "Jamie, keep this money. It's cheap capital. Use it to rebuild your bank." Any CEO would have accepted this offer. It was like free money. But I was thinking differently. I said to him, "Tim, we're going to pay this money back, all of it, as soon as possible." I can't forget the expression on his face. He was shocked. "Jamie, why? This doesn't make sense. Other banks are keeping this money. Why are you doing something different?" What I explained to him at that moment shaped the future of banking. "Tim," I said, "there's no such thing as free money. Every dollar you take, you have to pay something in return. And sometimes that price is more valuable than the money itself." What was that price? Independence. Freedom. The right to make our own decisions. Because when the government gives you money, it brings rules with it. It brings control. And I didn't want J.P. Morgan to become a plaything for politicians. But the real reason went deeper. After the 2008 crisis, the way the government interfered with banks scared me. Not just financial interference, operational interference, determining CEO salaries, interfering with credit policies, influencing business decisions. When I saw this, I understood. If I keep this money, J.P. Morgan won't be my bank anymore. It will be the government's bank. And I'll just be a salaried manager, not a real CEO. When I left that meeting, I told my team, "We're going to pay back the $25 billion. I don't know how we'll find it, but we'll find it." My CFO, Doug Bronstein, said to me, "Jamie, this is impossible. This money can be paid back in 2 years at the earliest." I said to him, "Doug, let's pay it back in 6 months." Why was I being so hasty? Because every day that passed, government control was increasing. Every month, new regulations were coming, new restrictions, new interventions. But here's the truly shocking part. Other bankers thought I was crazy. My colleagues on Wall Street would call me and say, "Jamie, what are you doing? This money is free capital. Why are you giving it back?" And that's when I realized something that would change everything about how I thought about power and control. The other CEOs weren't just keeping the money because it was cheap capital. They were keeping it because they were afraid. Afraid of having to find $25 billion on their own. Afraid of operating without government backup. Afraid of true independence. But I had learned something from the 2008 crisis that they apparently hadn't. Government money always comes with strings attached, and those strings eventually become chains. The question wasn't whether we could afford to give back $25 billion. The question was whether we could afford not to. This is where I'll tell you the real story behind that decision. The real danger isn't any single factor I mentioned. The real danger is their convergence. When real estate crashes while corporations default, while geopolitical tensions spike, while cyber attacks increase, while central banks are powerless, that's when the system breaks completely. Let me give you a scenario that keeps me awake at night. It's 2026. China invades Taiwan. Energy prices spike globally. The semiconductor supply chain collapses. Tech stocks crash 50%. Corporate bonds default at record rates. Meanwhile, a major cyber attack hits the Federal Reserve's payment system. Banks can't process transactions for 48 hours. Panic spreads faster than any virus ever could. That's not science fiction. That's a realistic scenario based on current risk factors. And if even 2 of those things happen simultaneously, we're looking at a crisis that makes 2008 look like a minor recession. Stop here, because this detail changes everything about how you should think about the future. Most people prepare for the last crisis. They build systems to prevent 2008 from happening again. But the next crisis will be completely different. Here's what happened in 2023 that proved my point. Silicon Valley Bank collapsed in 48 hours, not months, hours. Social media accelerated the bank run faster than regulators could respond. That's the new reality. crisis moves at internet speed now. But the truly shocking part had not been revealed yet. The speed of collapse isn't the biggest change. The interconnectedness is. When SVB failed, it didn't just hurt depositors, it threatened the entire venture capital ecosystem. Startup funding dried up globally. Innovation investments stopped. One regional bank failure almost crashed the entire tech sector. Now imagine that happening not to one bank, but to the entire financial system simultaneously. Imagine crypto markets crashing while traditional banks fail, while government bonds spike, while currencies fluctuate wildly. All happening in real time, amplified by social media, with no time for coordinated response. I've been stress testing JP Morgan for scenarios like this. We run simulations where multiple systems fail simultaneously. And even with all our preparations, even with our massive capital reserves, some scenarios are too severe for any single institution to handle. That's why I've been pushing for system-wide preparation, not just bank by bank, but coordinated global response mechanisms. Because when the perfect storm hits, national responses won't be enough. We'll need international coordination at speeds that current institutions aren't designed for. Let me tell you about the conversation that changed my entire perspective on systemic risk. It was early 2024. I was meeting with the head of the Bank for International Settlements. We were discussing global financial stability. He said something that chilled me. "Jamie, we're preparing for the last war while the next war is already being fought in cyberspace." He was right. While we're building higher capital buffers and stronger liquidity positions, the real threats are digital. Quantum computing that can break encryption overnight, AI systems that can manipulate markets faster than humans can detect, deepfake technology that can create false information and trigger bank runs based on complete fabrications. So far, you've only seen the traditional risks, but the digital risks are what will determine whether we survive the next crisis. Digital risks aren't just about cyber attacks, they're about the fundamental transformation of how financial panic spreads. In 1929, bank runs took weeks. People had to physically go to banks to withdraw money. In 2008, bank runs took days. People had to call or go online to move funds. In 2023, with SVB, bank runs took hours. People withdrew billions through mobile apps while lying in bed. The next crisis will move at millisecond speed. Algorithmic trading will amplify volatility. High-frequency trading will cascade failures across markets before human oversight can intervene. Social media will spread panic faster than facts, and mobile banking will enable massive fund movements with a few finger swipes. But here's what terrifies me most about the digital dimension. The people managing these systems don't understand finance, and the people understanding finance don't understand these systems. There's a dangerous knowledge gap at the intersection of technology and finance. I see this every day. We hire brilliant engineers who can build incredible technology, but they don't understand credit risk, market risk, or liquidity risk. Meanwhile, we have experienced bankers who understand traditional risks but can't grasp the implications of artificial intelligence or quantum computing. This knowledge gap creates blind spots. We're preparing for risks we understand while being blindsided by risks we can't see. And the attackers, whether they're nation-states or criminal organizations, are specifically targeting those blind spots. Let me give you a concrete example. Our payment systems process trillions of dollars daily. They're incredibly sophisticated, but they're also incredibly complex, and complexity creates vulnerabilities that simple systems don't have. A targeted attack on the right vulnerability could disrupt global commerce for days. Here's what happened in 2022 that almost became a systemic crisis. A solar flare disrupted satellite communications. For 6 hours, certain financial networks couldn't communicate properly. Trading slowed, payments delayed, international transfers failed. And that was just a natural event, not a deliberate attack. Imagine if that disruption lasted 6 days instead of 6 hours. Imagine if it was coordinated with cyber attacks on backup systems. Imagine if it happened during an already stressed market environment. The cascading failures would be unprecedented. That's why I've been investing billions in cybersecurity and system resilience, not just for JP Morgan, but pushing the entire industry to strengthen our collective defenses. Because in the next crisis, we're only as strong as our weakest link. But the decision no one expected came next. I decided that traditional stress testing wasn't enough. We needed to stress test for scenarios that haven't happened yet. Scenarios that combine digital attacks with physical disruptions, with economic shocks, with geopolitical crises. We built what we call perfect storm scenarios, not just what if unemployment rises or what if real estate crashes, but what if unemployment rises while real estate crashes, while China attacks Taiwan, while a cyber attack hits the power grid, while a pandemic disrupts supply chains. Running these scenarios was terrifying. Even JP Morgan, with all our resources, couldn't handle some combinations. And if we can't handle them, smaller institutions definitely can't. Which means when the perfect storm hits, it won't just be isolated failures, it will be system-wide collapse. This brings me to the hardest conversation I've ever had with a fellow CEO. The conversation was with the CEO of a major regional bank. I won't name him, but he runs an institution with $200 billion in assets. We were discussing systemic risk preparation. I told him about our perfect storm scenarios. His response shocked me. Jamie, we can't afford to prepare for every possible scenario. We have shareholders to satisfy and quarterly earnings to hit. That's when I realized the depth of our systemic vulnerability. It's not just that individual institutions might fail. It's that they're choosing not to prepare because preparation is expensive and shareholders don't want to pay for insurance they hope they'll never need. But here's what that CEO didn't understand. In the next crisis, there won't be government bailouts like 2008. Public sentiment has turned against bank rescues. Politicians won't risk their careers to save institutions that didn't prepare themselves. The banks that survive will be the ones that invested in preparation even when it hurt short-term profits. That's why I've been so aggressive about building JP Morgan's crisis resilience. Not just capital reserves, but operational resilience. Alternative communication systems if normal networks fail. Backup data centers if primary systems are attacked. Emergency liquidity sources if traditional funding dries up. We've even prepared for extreme scenarios like extended power outages or transportation shutdowns. Because in the next crisis, the institutions that can operate when others can't will be the ones that survive and thrive. But the truly shocking part had not been revealed yet. Individual bank preparation isn't enough. System stability requires coordinated preparation, and that coordination is failing because everyone assumes someone else will handle it. Banks assume regulators will coordinate responses. Regulators assume central banks will provide liquidity. Central banks assume governments will provide fiscal support. Governments assume international organizations will coordinate globally, and international organizations assume national governments will implement locally. This assumption chain is broken. No one has end-to-end responsibility for system-wide crisis response in a digital, interconnected, globally integrated financial system. We're preparing for the next crisis with institutional structures designed for the last century. Let me tell you what happened during a recent crisis simulation that opened my eyes. It was a joint exercise between major banks, regulators, and government agencies. The scenario was a coordinated cyber attack on payment systems during a market stress event. Within 2 hours of the simulation, communication broke down between agencies. Each organization had different protocols, different priorities, different legal authorities. The banks wanted to protect themselves. The regulators wanted to protect the system. The government wanted to protect the economy. Nobody could agree on coordinated action. And this was just a simulation. In a real crisis, with real money at risk, with real political pressure, with real media attention, the coordination failures would be catastrophic. That's when I made a decision that surprised even my own board. I decided JP Morgan would prepare to operate independently during the next crisis. Not just survive, but actually provide stability to the system when other institutions couldn't function. During that period, people asked me why I was spending so much on crisis preparation when our competitors were maximizing short-term returns. My answer was simple. Because someone has to be the adult in the room. When the next crisis hits, when coordination fails, when institutions collapse, when panic spreads, someone has to maintain stability. And if the government can't do it, if other banks won't do it, then we will. That's not altruism. That's enlightened self-interest. JP Morgan's long-term success depends on system stability. If the entire financial system collapses, being the strongest bank in a destroyed system isn't much of an achievement. We need the system to survive, so we're investing in systemic stability. But let me tell you something that might surprise you. I'm not just preparing JP Morgan for the next crisis, I'm preparing myself. Because crisis leadership at this level isn't just about having the right systems and capital. It's about having the psychological resilience to make impossible decisions under unimaginable pressure. I study every major crisis in history. Not just financial crises, but wars, pandemics, natural disasters. I want to understand how leaders behave when everything falls apart, what separates those who rise to the occasion from those who crack under pressure. Here's what I've learned. The leaders who succeed in extreme crises aren't the ones who are most confident. They're the ones who are most prepared. They've thought through scenarios that others haven't considered. They've built systems that others haven't invested in. They've developed decision-making processes that work under extreme stress. The next crisis will test every assumption we have about leadership, institutions, and system stability. The leaders and institutions that survive will be those who prepared for scenarios everyone else thought were impossible. I'm Dimon. I'm 67 years old. I've managed through multiple crises, but I'm more concerned about the next one than any previous one. Because this time, the stakes are higher, the risks are more complex, and the system is more fragile than ever before. The question isn't whether the next crisis is coming, it's whether we'll be ready when it arrives. And based on what I see in boardrooms, regulatory meetings, and international conferences, most people aren't taking the preparation seriously enough. They're focusing on optimizing for the current environment instead of building resilience for the next shock. They're maximizing short-term returns instead of investing in long-term survival. They're assuming the system will always have someone else to provide stability. But assumptions are dangerous in crisis situations. The only thing you can count on is what you've prepared for yourself. The only stability you can guarantee is what you've built with your own resources. That's why I'll keep pushing for more preparation, more resilience, more coordination, even when it hurts our quarterly earnings. Because when the next crisis hits, and it will hit, the institutions that prepared will be the ones that matter. The next crisis is coming. The only question is whether you'll be ready. And if you're not ready, don't expect someone else to save you. In the next crisis, survival will depend on preparation, not government bailouts. That's the truth nobody wants to hear. But it's the truth that might save your financial future if you listen to it.